Listen, I need you to stop whatever you're doing right now and pay attention because what I'm about to tell you could be the difference between financial security and complete disaster in 2026. If you have money sitting in a savings account, if you're planning to touch that money, if you're thinking about spending it or investing it or doing anything with it, you need to hear this first. Because the decisions you make with your savings in the next few months are going to determine whether you survive or get destroyed by what's coming. I've been managing money for over 40 years. I've built multiple companies. I've survived market crashes that wiped out millions of investors. I've seen people make catastrophic mistakes with their savings during every single recession. And right now, I'm watching the exact same patterns emerge that I saw in 2000, in 2008, and 2020. People are about to do incredibly stupid things with their savings. And I'm going to stop you from being one of them. The brutal truth is this: most people have no idea how to manage their savings. They treat their savings account like it's just sitting there doing nothing, when in reality it's the most important financial asset they have. Your savings is your defense. Your savings is your emergency fund. Your savings is what stands between you and complete financial ruin when the economy crashes. And people are about to throw that away. They're about to invest it in the stock market at the peak. They're about to buy real estate at inflated prices. They're about to spend it on things they don't need. They're about to make emotional decisions that will haunt them for decades. But first, before I tell you exactly what not to do with your savings, I need you to do something. If you're serious about protecting your financial future, if you understand that 2026 is going to separate winners from losers, if you want to make smart decisions instead of emotional ones, hit that subscribe button right now. Join this community of people who understand that financial discipline isn't optional, it's survival. We're building something here. A group of investors who think independently, who don't panic, who make rational decisions based on data instead of emotion. Here's the first thing you absolutely cannot do with your savings in 2026. Do not invest it in the stock market right now. I don't care what your broker says. I don't care what some financial influencer on social media told you. I don't care if your neighbor made money last year. The stock market is overvalued, and when it corrects, it's going to be brutal. The S&P 500 is trading at valuations that are historically high. Price-to-earnings ratios are above their long-term averages. Corporate earnings are being propped up by buybacks and financial engineering instead of real growth. The economy is slowing down, but stock prices keep going up. This is the definition of a disconnect. This is what happens right before crashes. I've seen this movie before. In 2000, everyone was convinced the dot-com boom would never end. Technology stocks were going to change everything. Traditional valuation metrics didn't matter anymore. It was a new paradigm. Then the market crashed, and people lost 70, 80, 90% of their money. The NASDAQ dropped 78% from peak to trough. Retirement accounts were wiped out. People who invested their savings at the top lost everything. In 2008, everyone was convinced real estate never goes down. Housing prices always appreciate. You can't lose money in real estate. Then the market crashed, and people lost their homes, their savings, their retirement. Banks failed. The economy went into the worst recession since the Great Depression. People who invested their savings in real estate at the peak got destroyed. Right now, we're seeing the same psychological patterns, the same irrational exuberance, the same belief that this time is different. It's not different. Markets go up and markets go down. And when they go down from these levels, the crash is going to be catastrophic. Your savings needs to stay in cash. In high-yield savings accounts earning 5% with zero risk, in treasury bills backed by the full faith and credit of the United States government, in money market funds that are liquid and safe. Boring? Absolutely. Safe? Completely. And safety is what matters when you're staring down a potential market crash. Rich people preserve capital during uncertain times. Poor people chase returns and get destroyed. Don't invest your savings in stocks right now. Keep it safe. Keep it liquid. Keep it available for when the real opportunities emerge after the crash. The second thing you cannot do with your savings is buy real estate in overheated markets. This is going to upset people because real estate has this magical hold on people's psychology. Everyone wants to own a home. Everyone's been told real estate is the best investment. Everyone sees their friends buying houses and feels left out. Stop. Think. Calculate. Real estate prices in most major markets are completely disconnected from economic fundamentals right now. The median home price to median income ratio is at historic highs. In many cities, you need to earn over $100,000 per year just to afford a median-priced home. Mortgage rates, even after some recent cuts, are still double what they were just a few years ago. At 7%, your monthly payment on a $500,000 mortgage is over $3,000 just for principal and interest. Add in property taxes, insurance, maintenance, and you're looking at $4,000 plus per month. That's $48,000 per year just to live in a house. And that's assuming you have the 20% down payment, which is $100,000 in cash. So you need $100,000 in savings just for the down payment, plus closing costs, plus moving expenses, plus furniture, plus repairs. You're looking at spending $120,000 to $130,000 of your savings to buy a house that might drop 20% in value when the market corrects. This is financial insanity. I'm not saying never buy real estate. I'm saying don't buy real estate right now with your precious savings when prices are at or near peak levels. Wait, be patient. Let the market correct. It will correct. Housing markets are cyclical. They go up and they go down. And when interest rates were at 3%, people were buying houses they could barely afford. Now rates are at 7% and prices haven't come down proportionally. Something has to give. Either rates drop significantly, which would require a recession, or prices drop significantly to match affordability. Either way, if you buy now, you're buying at the worst possible time. Keep your savings safe. Rent if you need to. Wait for the correction. You'll save $100,000 or more by being patient for 12 to 18 months. That's the discipline that separates wealthy people from broke people. The third catastrophic mistake people make with their savings is paying off low-interest debt. This sounds counterintuitive because everyone tells you to be debt-free. Get rid of all your debt. Pay off everything. Wrong. Not all debt is bad debt. And using your savings to pay off low-interest debt right before a potential recession is one of the dumbest financial moves you can make. Here's why. Let's say you have $30,000 in savings and you have a car loan at 4% interest. Your financial advisor, who doesn't understand cash flow or risk management, tells you to pay off the car loan, be debt-free, sleep better at night. So you take your $30,000 in savings and pay off the car. Now you have zero savings and no car payment. Congratulations. You just eliminated your financial safety net to save 4% interest. Now the recession hits. You lose your job. You have no savings, no emergency fund, no cushion. You can't make your rent payment. You can't buy groceries. You're scrambling to put expenses on credit cards at 24% interest. You just traded 4% debt for 24% debt because you made an emotional decision instead of a mathematical one. Savings is defense. Low-interest debt is irrelevant when you have an emergency fund. I would rather have $50,000 in savings and a car loan at 4% than zero savings and no car payment. Because when emergencies happen, and they will happen, especially in 2026, cash is king. You can't call the bank and ask for your car payment back. That money is gone. But if you kept it in savings, it's there earning 5% in a high-yield account, available immediately when you need it. The only debt you should pay off with savings is high-interest credit card debt above 10%. Everything else, car loans at 4 or 5%, student loans at 3 or 4%, even mortgages at 6 or 7%, leave them alone. Keep your savings intact. Preserve your emergency fund, because liquidity is going to be more valuable than avoiding low-interest debt payments when the economy crashes. Rich people understand leverage and cash flow. Poor people are obsessed with being debt-free even when it destroys their financial flexibility. Don't make that mistake with your savings. The fourth thing you absolutely cannot do is spend your savings on lifestyle upgrades. This is the most common and most destructive mistake people make. They have money sitting in savings earning 5%, and they convince themselves they deserve to spend it. They want a new car. They want a vacation. They want to remodel the kitchen. They want new furniture. They want designer clothes. They want toys and gadgets and experiences. And they justify it by saying they've been saving for years. They work hard. They deserve it. No, you don't deserve to destroy your financial security for temporary pleasure. That's not how wealth works. That's how broke people stay broke. Your savings is not there to fund your lifestyle. Your savings is there to protect you from disaster, to give you options when life goes wrong. to provide security when the economy collapses, to create opportunity when everyone else is desperate. Every dollar you spend from savings on lifestyle is a dollar you won't have when you lose your job, when your car breaks down, when you have a medical emergency, when the market crashes and creates buying opportunities. I see this pattern constantly. People save $20,000 or $30,000 and then they blow it on a new truck or a trip to Europe or a wedding or furniture. Then 6 months later, they're broke again, scrambling to rebuild their emergency fund, putting expenses on credit cards because they have no cushion. It's a cycle of financial stupidity that keeps people poor forever. Wealthy people protect their savings like it's sacred. They don't touch it for lifestyle. They live below their means. They drive older cars. They take modest vacations. They resist the temptation to spend just because they have money available. That discipline, that ability to delay gratification, that's what separates rich from poor. If you want something, if you want to upgrade your lifestyle, fine. But fund it from income, not from savings. Work overtime. Get a side hustle. Sell things you don't need. But don't raid your emergency fund to buy things that lose value the second you buy them. Your savings is off limits for lifestyle spending. Period. No exceptions. That's a rule that will keep you financially secure when everyone around you is drowning in debt and regret. The fifth, and perhaps most dangerous thing people do with savings, is put it into speculative investments they don't understand. Cryptocurrencies, options trading, penny stocks, real estate crowdfunding, peer-to-peer lending, NFTs, whatever the latest investment fad happens to be. Your savings is not gambling money. Your savings is not speculation capital. Your savings is not for taking risks on investments you saw advertised on social media. I cannot tell you how many people I've seen lose their entire emergency fund by putting it into Bitcoin at $60,000, or by day trading options, or by investing in some startup that promised incredible returns. They take money that's supposed to be safe and liquid, and they gamble it on things they don't understand because they're greedy. Because 5% in a savings account feels too slow. Because they want to get rich quick. Because some influencer told them this is the future. Then the investment crashes. The cryptocurrency drops 70%. The options expire worthless. The startup goes bankrupt. The peer-to-peer loans default. And their savings is gone. Completely wiped out. Now they have no emergency fund, no safety net, no defense against the next crisis. And the crisis is coming. Your savings needs to be in boring, safe, liquid investments, high-yield savings accounts, treasury bills, money market funds, FDIC-insured bank accounts. Things that don't lose value. Things you can access immediately. Things that aren't going to disappear overnight because some exchange got hacked or some company went bankrupt. If you want to speculate, if you want to invest in risky assets, fine. But do it with money you can afford to lose completely. Do it with extra money after you've built a solid emergency fund. Do it with 5 or 10% of your portfolio, not with your entire savings. Rich people keep their emergency funds safe and speculate with risk capital. Poor people gamble their savings and end up with nothing. Don't be poor. Protect your savings from your own greed and stupidity. Now let me tell you exactly what you should be doing with your savings right now, today, to prepare for 2026. First, you need a minimum of 6 months of expenses in cash, not invested, not in stocks, not in real estate, in actual cash sitting in a high-yield savings account earning 5%. Calculate your monthly expenses. Rent, food, insurance, utilities, debt payments, everything. Multiply by 6. That's your minimum emergency fund. If you don't have that amount, stop doing everything else financially until you build it. No investing, no extra debt payments, no lifestyle upgrades. Build the emergency fund first. It's your foundation. Second, once you have 6 months of expenses saved, consider building it to 12 months if you work in a volatile industry, if you're self-employed, if you have dependents, if you have any job insecurity. 12 months of expenses in cash gives you incredible freedom and security. You can weather any storm. You can take risks in your career. You can wait for opportunities. You're not desperate. Third, keep that emergency fund in the highest yield savings account you can find. Right now, several online banks are paying over 5% on savings. That's essentially a risk-free return that keeps pace with inflation. Don't leave your savings in a big bank checking account earning 0.1%. You're losing money to inflation. Move it to a high-yield savings account today. Fourth, once your emergency fund is fully funded, then and only then should you consider investing additional savings. But do it intelligently. dollar cost average into low cost index funds, max out tax advantaged retirement accounts, invest in assets you understand. Don't chase returns, don't speculate, build wealth slowly and steadily. Fifth, resist every temptation to touch your emergency fund unless it's an actual emergency. Job loss is an emergency. Medical crisis is an emergency. Major car repair when you need the car for work is an emergency. A vacation is not an emergency. New furniture is not an emergency. The latest iPhone is not an emergency. Discipline yourself to define emergency correctly. Here's what's going to happen in 2026 that makes all of this critically important. The economy is going to slow down significantly. Corporate earnings are going to disappoint. The stock market is going to correct, probably by 20 to 30% at minimum. Real estate prices in overheated markets are going to decline. Unemployment is going to rise. Credit conditions are going to tighten. People who didn't prepare, who spent their savings, who invested at the peak, who bought overpriced real estate, who didn't maintain emergency funds, they're going to get absolutely destroyed. But people who followed this advice, who kept their savings safe, who maintained liquidity, who resisted temptation, they're going to survive. More than survive. They're going to thrive. Because when everyone else is desperate, when stocks are down 40%, when real estate is corrected, when people are selling assets at fire sale prices just to pay their bills, that's when the real opportunities emerge. That's when you deploy capital. That's when you buy incredible assets at incredible prices, but only if you protected your savings now. Only if you had the discipline to keep it safe when everyone else was chasing returns. I've made millions by being patient, by keeping cash available, by waiting for opportunities instead of forcing investments. The biggest gains I've ever made came from deploying capital during crashes when everyone else was panicking. But I could only do that because I had capital available, because I didn't blow my savings on stupid things, because I didn't invest at the peak, because I was disciplined enough to be boring and safe when everyone else was being greedy and risky. You can do the exact same thing. Protect your savings now. Keep it safe, liquid, and available. Resist every temptation to invest it, spend it, or gamble it. Build your emergency fund to 6 or 12 months of expenses, and then wait. Wait for the correction that's coming. Wait for the opportunities that will emerge. Wait for the moment when having cash makes you rich while everyone else is broke. That's the game. That's how wealth is actually built. Not by chasing returns, but by preserving capital and deploying it intelligently when the time is right. If you understand this message, if you're willing to be disciplined, smash that like button. Share this with someone who needs to protect their savings. Become a member of this channel and join a community of people who understand that financial security comes from discipline, not from speculation. Your savings is your most important financial asset ever. Protect it carefully and wisely today. Sometimes the best decision is no decision at all. Cash earning 5% with zero risk is incredibly smart. Wall Street hates this because they profit when you trade constantly. The truth is, cash is real power. With reserves, you have options. You can wait for opportunities and capitalize on crashes. People fully invested are completely trapped. I maintain cash reserves because dry powder is extremely valuable. Cash earning 5% is intelligent strategy. When correction comes, deploy capital at better prices. That's true wealth building.